Can you get a business loan with bad credit? Here's what lenders actually look at. Yolanda runs a hair salon that pulls in $40,000 a month, reliably for the past 2 years. Her chairs are booked, her staff is paid, her business is healthy. Personal credit score is 580. It's not from the business. It's an old medical collection from years ago, sitting on a report, dragging her number down every time she checks. She's convinced that the number is a locked door. So convinced that she doesn't apply for any financing at all. Not because she got rejected, but because she assumed the rejection before she even checked. Can you actually get approved with this credit score like that? Well, what are lenders really weighing here? Usually not. Sometimes actually yes. This video is built exactly for that situation. In this video, I'll explain how bad credit business lending actually works, what lenders look at instead of your credit score, when it makes sense, when it doesn't, and how to know if it's the right fit for you. Here's what's actually happening to Yolanda. In plain terms, her salon deposits roughly $40,000 a month into her business account. That pattern has held steady for 2 years. No wild swings, no missed months. Meanwhile, her personal credit score sits at 580, which by traditional bank standards looks like a red flag on paper. So pretty much this collection notice from her past is standing in front of her business that's performing fine right now. Here's how the real mechanism works. A bank loan officer starts with your credit score and then works backwards. Score first, everything else second. But that's not the only question a lender could ask. The better question, the one alternative lenders actually ask, is simpler. What is the business doing with its money right now? To answer that, they look at a handful of things. Consistent monthly deposits. Is money actually moving through the account? And how much? Time in business. Has this been running long enough to show a real pattern, not a guess? The trend of revenue. Is it flat, growing, or sliding? Because a declining trend tells a very different story than a stable one. And existing debt. How much is already coming out of the account daily or weekly to pay off other loans or advances? Because that eats into what's left over. Credit score is one input in that picture. It's not the gate that closes the door by itself. Yolanda pulls her last 4 months of bank statements. The deposits are consistent, right around $40,000 a month. No other debt payments are draining the account daily. The trend line is flat and steady, not declining. Based on that pattern, she gets approved for working capital, despite the 580 score. That's the whole idea behind cash flow underwriting. It looks at what the business is doing now, not just a 3-digit number from the past. Yolanda's score told a story about an old medical bill. Her bank account told a story about how that salon works. Quick recap, and this is the part that people get wrong. People assume one bad number cancels out everything else about the business. It doesn't. Not with this type of lender. The same logic that helped Yolanda applies to a contractor with seasonal dips but steady annual revenue, a restaurant owner with thin margins but daily consistent deposits, or a retailer carrying old personal debt that has nothing to do with how the store performs today. The score is context. The cash flow is the current picture. So when does this actually make sense? Use this when your revenue is steady or growing even if your credit isn't. Use this when your low scores come in from something separate from your business, like Yolanda's medical condition, rather than mismanaging business debt. Use this when you have real bank statements to show, not just an idea of what you make. Use this when you need capital now and can't afford waiting months to try to repair the credit score first. Here's the key concept. Cash flow underwriting, it's about weighing current business performance more heavier than a historical record. For Yolanda, that means her 2 years of steady $40,000 months mattered more than her collection account from the hospital a few years ago. Now here's when to walk away instead. Is your revenue actually declining month over month, not just your credit score? Are you already sending a big chunk of daily revenue to other debt payments? Is your bad credit tied to how you handle business obligations recently? Not something old and unrelated. Do you have no real bank history to show a lender because you're too new or disorganized? If those are true, fix that first. The math won't work yet. A bad score can close some doors, but not all of them. The wrong question is, will bad credit get me rejected? The better question is, does my business show a lender something a bank never looks at? For Yolanda, the answer changed everything, because that thing at stake wasn't her credit report, it's whether her salon could keep growing. If you think cash flow underwriting could help you with your next purchase or business opportunity, click the link below and talk to our team at Outcome 99. We'll review your exact situation, walk you through every option, and tell you honestly if it makes sense and help you move fast if it does.